All right. Today's Sunday, the 22nd of December. This is not a recap for the stock market activities, but this is a technical update, which will be handy because we have a short trading holiday week coming up. The holidays are closing in. So I hope everybody's having a great weekend. But I'll give you a little bit of an update because this week, the week that was, we went down big in the aftermath of the FOMC. Then we got a big rebound Friday, which was really interesting because we've seen initially in the day, we've seen an inverse gamma squeeze that took us down to the same SPY numbers that we discussed in the previous video. And then we've seen an actual gamma squeeze that took us all the way up to the numbers that we discussed, the 595. And then we've seen a drop down at the end of the day. So interesting session, but what does it say about this upcoming week? Because OPEX is OPEX and a lot of action happens, but now we have a fresh new week. So let's begin with the indicators. You got the VIX, you got yields, you got the dollar. Each asset is going to react in a certain way depending on how the indicators will do next week. I want to start with the most important, which is the VIX, because that's going to impact the big caps and that's going to impact the indices. But before we begin, of course, it's not just the VIX. I'd love always to look at my favorite indicator, which is the J&K, and see how it's doing. If it is going down, that indicates the market is probably going to head down, and you cannot trust the rallies or the pops that you see. If J&K is moving up, then you don't want to trust the drops that you see, the gap downs. And if I look at the J&K right now, of course, it got the daily chart. This is what I'm looking at. It got really excessive by going down below the Bollinger Bands, but it managed to rebound on Friday and close above the open of the previous candle. So two things that we can extract from the chart of J&K. We were oversold, and we have corrected a lot of the oversold conditions that we got. Can we continue in that oversold rebound? Sure, we can do that just to get back within the Bollinger Bands. Number two, it is technically considered a reversal when you close above the open of a previous candle. This could lead to, let's say, Monday becoming positive, maybe Tuesday we continue to see a little bit of that rebound. But the problem is it's a long wave before we say that it's a full recovery, meaning it's a bottom in J&K, bottom in the market. Because you look at the weekly chart, you see that we have a massive potential here for more downside coming in J&K. But in the short run, it is showing positive signs for the market. Now, let's go to the OG indicator, which is the VIX volatility. Are folks hedging or not hedging? Of course, on Friday, a lot of the hedging was taken off. You see a big flush down candle in the VIX, reaching the 100 days moving average in or around 18. Can we see furthermore declines in the VIX? Obviously, of course. That is a possibility with the lower volume holiday weekend. But when I look at the weekly chart of the VIX, we closed above the 20 weeks moving average. And usually I buy the VIX when I see it closing above the 20 weeks moving average because usually more than not, we see a continuation of that move once the VIX closes above the 20 weeks moving average. So here's what you want to look at. Say the VIX continues to go down Monday, Tuesday. The most important question is, how will the VIX close? Will it close the week below the 20 moving average at 1713 or not? Because if it declines all the way to 1713 or a little below, then it comes back above that number, let's say by the second half of the week, that's going to be problematic. Because that's going to indicate that the VIX went down a little bit to retreat some of the move from the FOMC, but it's coming on its way higher again. And we're not finished with the move higher that we've seen in the VIX in the aftermath of the FOMC. And that, of course, ties in with the title of the video. You got on one hand the fear of the rate policy. That's not going to evaporate anytime soon, but you also have the positive seasonality. And I think it's going to play out with short-term positive. Then after we're done with the seasonality, we go back to negative. And that also solidifies that maybe the VIX goes down a little bit Monday, Tuesday, then it comes back up again. The closing above or below the 20 weeks moving average will become really critical. Now that we talked about the indicator, let's talk about the assets related to the indicator. We begin with Apple because Apple has the heaviest weight in the indices. It's really important. No confirmation for a bearish reversal yet because we're still above 245.50. And it seems to me that Apple is the poster boy of the seasonality. It keeps getting bought the moment folks want to buy the indices. They buy Apple right away. And not to forget, of course, the inverse relationship with NVIDIA, at least for now. When NVIDIA is weak, Apple gets a bid. It's super frustrating for anybody who's looking at, let's say, the fundamentals of Apple. When you think about the valuation being the highest ever, even though the fundamentals of the company, the revenue growth, the profit growth has slowed down dramatically. When you think about the technical overextension, all of these on the back of our heads, but it's not playing out right now because Apple is the biggest benefactor of the seasonality. when we see it closing like we've done on Friday, by closing above the highs of Thursday's and Wednesday's sessions, that is also considered a bullish reversal. So it could point out to more gains in Apple. That could lead the indices higher, VIX a little down, and then we'll see what happens in the second half of the week. But you don't have that bearish confirmation to go aggressive against Apple until we lose 245.5, then it begins to play out. The other heavyweight name that tracks the VIX or impacted by the VIX is NVIDIA, of course. And NVIDIA right now found some stability session after session after session above the 100 days moving average, but it still has the 50 in blue as the resistance. The way I think about it, if NVIDIA wanted to break the 100 days moving average, it could have done that in the last few days, but it didn't. Would it do it now when we have favorable seasonality? That's hard to see. So NVIDIA has the possibility of moving all the way up to retrace the 50 days moving average. And this is why, as you'll see in the end of the video, NVIDIA was my bullish trade for this upcoming week. We'll talk about that in a second, but 2 important points. If it loses the 100 days moving average in red at any point, that's going to be considered as opening the gate for more declines to come, and you want to chase that momentum. If we hit to the 50 days moving average, and then we fail to close above and print a reversal candle from that point on, then we're going to for sure take out the 100 days moving average, and that's going to be a point where we want to add puts and shorts in NVIDIA. Now, if NVIDIA manages to close above the 50 days moving average, then it's probably going to head out to challenge the shoulder line in the topping head and shoulder pattern. So keep an eye on these outcomes, but for now, it appears that NVIDIA has what it needs to at least begin to move higher a little bit under favorable seasonality, absent of a spike in the VIX. Looking at the indices, the SPY also impacted by the VIX. An hourly chart, what do we see here? Got a flush down in the morning, only to find the buyers coming back right away, among them, of course, the market maker. And now the risk is to the upside could be that we have an ABC breakout. Momentum was oversold. If you look at the RSI, the MACD, and now it's improving a little bit. So there is possibility that the SPY could move in an ABC pattern and let's say re-challenge 599 as resistance. What is the line in the sand? That, okay, we don't have an ABC breakout, and Friday's session was all about OPEX, and now we're going to go down further to reach support. That number, my red line, is 585.89. You close below that for the hour, it'll probably indicate that we have more declines to come, and the next support will be at closing another gap. That'd be 576.71. Looking at the daily chart for the SPY, again, it got really oversold in the morning on Friday because it gapped below the lower Bollinger Bands. It came all the way up, but it did not close above the 50 days moving average. So right now we treat it as an oversold rebound, probably influenced by OPEX. But because of the seasonality that we have in this upcoming week, the assumption should be, at least entering the week, that we should be going higher until proven otherwise. Looking at the daily chart for the E-mini futures, again, got a little oversold in Friday's session in the morning. We never really closed below the support that I got, which is 5,928.25. So for now, it appears to be an oversold rebound. How do we treat it though? Clean up the chart, plug in your 50 days moving average in blue, your 100 days moving average in red. Obviously, at any point, if we go down below the 100 days moving average, that's going to be a shorting signal because we have more pain to come. If we break above the 50 days moving average and close above, that's going to indicate that we found some support. We're probably going to challenge the top of the breakdown candle. But so long as we're stuck between, we can trade day by day. We can do some cute games, but you're not going to fire up big guns in terms of puts or calls until you close above the 50 or below the 100 days moving average. So you have a few layers of confirmation. The support of 5,928.25. And then you have the 100 days moving average. And on the weekly chart, once again, look at this. We broke below the rising wedge pattern. At the end of the day, I think that the wave that you see in the MACD will turn negative. It's just a question of when, not if. But yet again, you have two layers of confirmation here. Besides the 100 days moving average, the 5,928.25. If that's broken, then you have the 100 days moving average. You break the 100 days moving average. You have the third line of defense, which is 5,780. You close below that by the end of the week. Oh boy, we have further more declines to come. We'll probably be at the 5,300 level at some point in the year 2025. Looking at the Qs and hourly chart, what do we see here? Of course, the risk right now is an ABC breakout. It could lead us all the way back to 526.91. Another way to look at it, there could be an inverse head and shoulder pattern. We were oversold in the RSI and the MACD, no longer oversold. So we can go down theoretically, but for now, the momentum remains positive. At least it is improving from oversold conditions. So what is the line in the sand here? I'll take it a notch down below my number because my number 517.15 maybe a little conservative here, just measuring the gap. So let's be more liberal with it because that's what you want to do when you're betting on the downside, especially in a week where the seasonality is favorable to the market. And the number would be 516.14. If you take that number out, that's going to be, of course, the inverse shoulder line. If you close below that, then we're probably heading lower in the Qs, and Friday's rebound was just an OPEX phenomenon. Looking at the daily chart for the Qs, below the 20 days moving average, but we haven't hit the 50 yet. We haven't broken below the 50, so it looks a lot better than the SPY. What else do we see? Looking at the Qs, if we clean up the chart, when we see these breakdown candles, more times than not, we see more declines to follow. So once again, the assumption should be that we can have some oversold rebound yet again, some seasonality play out. But so long as we're staying below the top of that breakdown candle, the risk remains that once we come back from the holidays, we see the ugliness resuming once again. Looking at the NASDAQ E-mini futures, it kind of broke below the rising wedge pattern, but I'd like to look at the weekly, and the weekly did not. It didn't break below the 50 days moving average either in blue. It didn't break below my support, 20,522. So all in all, we don't have a severe technical damage here in the Qs. If you look at the weekly chart, never really closed below the rising wedge. Maybe it's going to do that this week or before the end of the year. But right now, the Qs remain stronger than the SPY. And if we have a favorable seasonality, you're probably going to still see the Qs outperforming the SPY. So that wraps up the conversation about the VIX. It indicates the openness for more declines in the VIX, more rebounding in the indices. But until you resolve the weekly charts, you close below the 20 weeks moving average in the VIX, we're not out of the woods yet. If we look at the yield cohort that impacts all of the stocks and the sectors that you see right here, let's begin with the 30-year bond yield. Of course, the PCE inflation report came favorable to the market, and this is why we've seen yields and the dollar going down initially. And I said, look, if yields go down, you want to be all in buying these dips that we've seen in the yield-sensitive names because they have the best potential of coming back. But look at the close that we got in the 30-year bond yield on Friday. It is above the lows from Thursday's session, a tick below the close from Thursday's session, but it doesn't show any reversal at all. It doesn't show that we've done a bearish engulfing candle, for example. It doesn't indicate that we have more downside to come. Sure, we have an elevated RSI, but who's to say that we're not going to go a little overbought in the RSI before we see the 30-year bond yield going down? Furthermore, you look at the weekly chart for the 30-year bond yield, and again, it suggests that we're probably not done here. We're just facing a little bit of resistance, but we're probably going to head higher. So how do we approach yield-sensitive assets? Like the IWM, for example, the poster boy. Now, if yields made a reversal candle Friday, I was favoring the IWM. I would have gone with the IWM in a big way, betting on a rebound. But all of what we gotten is a rebound out of a gap below the lower Bollinger Bands. So we got a little oversold, but we never closed above the Bollinger Bands, whenever closed above the 100 days moving average that you see in red. So all in all, it remains a weak rebound. The result of oversold conditions, that's about it. And the risk, of course, that without closing above the 100 days moving average, the IWM risks going all the way down. If you plug in the 200 days moving average in orange here, that'll be in or around 214. That's going to be the next stop for the IWM. So now you know, closing above the 100 days moving average, you look at the 30 bond yield, and if it's going down, you got your confirmation. You probably want to go along the IWM, at least for a day or two. If you don't see a close above the 100, if you see the 30-year bond yield moving higher again, your assumption should be that the IWM is heading down to its 200 days moving average. When we look at other assets that are yield sensitive, like the XHP home builders, again, we got a rebound because we got really oversold outside of the bands, and we got really oversold in the RSI, but we did not close above the highs or even the open of the previous candle. So there is no bullish reversal in the XHP. And furthermore, the 30-year bond yield does not confirm a bullish reversal in the XHP either because it did not have a bearish reversal. Therefore, when we look at the rebound in the XHP, sure, it's an oversold rebound, but it's too dangerous to follow right now without confirmation from bond yields going down. I think once again, since we went down all the way here, why not just close the gap that I'm highlighting in the chart right now? You look at another yield-sensitive IYR real estate. What do we see here? Similar look as the XHB, but if we plug in the 200 days moving average in orange, we got a retest, but we closed below. That is a sign of weakness that you only got an oversold rebound, but no confirmation. So once again, you need to see a bearish reversal candle in the 30-year bond yield. You need to see the IYR closing above the 200 days moving average before you begin betting on those assets. Now pay attention, because when I talk about if there's a rebound, a Santa rebound, which one do you want to follow? The stuff that is impacted by the VIX, the stuff that is impacted by bond yields, or the stuff that is impacted by the dollar? So far, in this discussion, it appears to me that the stuff that follows the VIX is a better bid than the stuff that follows bond yields, because we have no confirmations at all from these assets or from the indicator that is turning negative. The VIX, on the other hand, showed a sign that we can open more downside. Apple broke above the opening of two previous candles. So at least with the VIX cohort, we have a little bit of confirmation that yes, that could play out better in favorable seasonality. If we talk about the IYR again, weekly chart, it reached below the Fibonacci retracement, 38.20%. It has the possibility, when you look at the RSI, it's not oversold at all, so we can go down further in the IYR and reach the 50 weekly retracement line. Now the KRE daily chart, if I'm going to follow anything that is influenced by bond yields and let's say favorable seasonality, where we see between the XHB, IWM, IYR, and KRE, if I have to speculate on something that's going to move higher from these four assets, I'd probably pick the KRE. And the reason is the KRE defied the 30-year bond yield multiple times before. And it was actually following the XLF, the big banks, which are impacted by the steepening of the yield curve. If we see steepening in the yield curve, that's good for the big banks. And if that's good for the big banks, what if the KRE regional banks just algorithmically follows the big banks and ignores the 30-year bond yield going higher? We've seen that before. And right now, the KRE caught a rebound from the 100 days moving average, so it's not below the 200 as we see in the IYR or the XHB. And it closed the gap at 59, almost that number. So if there's any of these four assets that's going to rebound, I think it's going to be the KRE. What about the dollar, though? Because the dollar went down and closed in a bearish engulfing candle. Not quite the reversal candle yet, because we haven't reversed the breakout candle. If you close below the lows of that candle, you're probably going to see confirmation in the MACD, and that's going to be the ultimate confirmation that the dollar is done going higher, and now you have to be really, really aggressive in buying the dips in these dollar-sensitive assets. But right now, the daily bearish engulfing candle, which is a smaller and less meaningful signal for a reversal, is good enough to begin to speculate a little bit in buying the dips in these dollar-sensitive assets. So if we look at the old man gold, it caught a rebound of 2,600. That's the good news. We never broke below 2,600, and that's a must-keep kind of line. Bad news, we got a retest of the 100 days moving average. We couldn't close above. So it could be a dead cat bounce because we've never reversed the breakdown candle. You do that once you close above the top of that candle. That didn't happen yet, but it will happen if the dollar closes below the low of its breakout candle. Then gold is going to close above the high of its breakdown candle. See how that works out? And then you have the ultimate confirmation that you should be hand over fist buying gold, because the dollar is going to continue to decline. But right now, I'd be really, really careful, because you look at the GDX, the gold miners, which is more sensitive than the asset gold to the dollar. It is still maintaining a head and shoulder pattern and flirting with losing the 50 weeks moving average. It actually closed a touch below. So that's a warning sign that you have to be really careful. And right now, we're not out of the woods yet. Sure, the dollar showed a sign of weakness, but it is not in the bag. So let's say you want to bet on favorable seasonality on the dollar side. You're probably better off using the SLV silver, because it is more sensitive. Sure, it is below the 200 days moving average and showing the same patterns as we see in the GDX on the weekly chart. But SLV is cheaper than GDX, not just from price point wise, but also from the options premiums wise. So if I'm going to speculate on the dollar going down and seasonality lifting these dollar sensitive assets higher, I would probably go short-term calls on the SLV. Then I'm going to complement it with long-term puts on the GDX. In other words, I'm playing oversold conditions in the SLV chart on the daily time frame, but I'm playing the head and shoulder topping pattern on the GDX on the weekly chart. So it would be something such as buying the December 27th call and SLV, let's say the 27. You don't want to go way outside of the money because this is a shorter trading week. And then I'm going to complement it with GDX puts for Jan or February. And that might be all the way down to 32. That would be a really rational and decent trade to have if you're betting on the dollar side. What about crude oil, though? Because crude oil is also dollar sensitive, but we've explained the correlation that crude been correlating positively with the dollar, not negatively as we usually think. That happens from time to time. But recently it's been positive correlation. Crude did not catch up with the dollar, though. So the question now becomes, if the dollar stays strong, is there a catch-up trade for crude oil where we see it going higher? Yes, But that's probably going to be on the investor side of the equation, not the trader side. If you're a trader and you're trying to play with the dollar-sensitive assets, I suggest you stick with the metals because those are going to move accordingly to the dollar this upcoming week. On the other hand, crude oil could be its own animal and defy the dollar or trade with the dollar or do funny things. Not the best assets to play in this upcoming week if you're playing the seasonality. If you're playing, let's say, Jan or February's options, or you're looking to buy the dips, for example, from an investor standpoint, what you need to see is crude oil now consolidating in what looks like a bull flag pattern. If we close in the daily time frame above the 100 days moving average in red, let's call that 70. If we do that, the odds would suggest that crude oil has more upside to come in the year 25 because it's going to catch up with the dollar. And at that point, you want to be long XLE, ExxonMobil, Oxy, anything you want to choose really in the crude oil cohort would do fine once we cross above 70 and close the day above 70. I think from an investor's point of view, that would be, for me at least, a green light to begin to accumulate more and buy the dips more in energy stocks. So again, in summary, folks, if you're going to play the seasonality of this upcoming week, you're better off trading the indices, the big caps, Apple specifically, NVIDIA, the yields and the Dixie cohort not showing strong signs that they're going down and the respective assets could be trading higher because of this week. Now, what about some miscellaneous charts that are not bounded by the VIX, bond yields, or the dollar, at least not right now, such as Tesla? This is the hourly chart of Tesla. Again, it's mostly a mechanical phenomenon. It's about call options, put options. Does it look weak? Yes, it does, because we got a bear flag pattern that took us all the way down and a gap down Friday. A little bit of a recovery, but we closed at the lows of the session. That suggests weakness to come, but do we have the confirmation? We don't have it yet. If we close below 417, we got it. But the odds would suggest that Tesla could be getting soft because the majority of buyers, folks, who bought Tesla recently, they did it because of the post-election rally. Be it via calls or shares, doesn't matter. So the selling decision is not really tax related as we see in Apple, for example. Apple is somebody who bought earlier in the year. They have no incentive to sell right now. But a Tesla buyer has the incentive. The weaker hand that got recently has the incentive to sell, book their profits, get out, and then reassess next year. So I think that Tesla could have more downside to come this week, especially if it closes below 417. And then what about Bitcoin? Another miscellaneous, not really tracking the dollar, not really tracking anything. But it is a pulse for the risk-on sentiment. And when I see Bitcoin down, I'm kind of skeptical about will the seasonality really play out? Because if the seasonality is going to play out and favor stocks higher this week, then Bitcoin should be trading higher. But it's not. Now, does that mean that we have a signal to short Bitcoin? Not quite yet. Because go back to the weekly chart. And remember the discussion that we got. The daily closings are significant, but they're not as significant as the weeklies. The weeklies are the ultimate ones. And we've never got a weekly close above 104,000 to give us that buy signal. Do we have a close on the sell signal line, which is right now sitting at 92,055.86? The answer is not quite yet. If we do that, then I would say yes. We're probably going to see the weaker hands, just like we got with Tesla, coming out before the end of the year, locking profits. But we see a flush in Bitcoin too. So these two assets, not really bounded by the VIX, dollar, bond yields too much. They have more of a sentiment indicator. And of course, the dynamic of the weaker hands could impact them more than the seasonality this upcoming week. In summary, what do we do here with the trades for the week? This is what I gave you before the closing of the session on Friday. And apologies, I tried to fire up a longer tweet, post, whatever this is, on Discord, but the Wi-Fi in the plane was absolutely horrific. So I'm lucky just that I was able to get this out. And I said when it comes to the indicators, VIX possible more downside next week. Dixie short-term bearish reversal. That could be for a day or two, but not the strongest yet. And yields, no confirmation of reversal. So what do? Watch the 50 days moving average on the SPY. If we close below, then we're still under the assumption that this could be a dead cat bounce. We close above, no, we got confirmation. So far, we closed below. So that also keeps the bearish thesis alive, that this was a dead cat bounce. But again, the seasonality is also an important thing to keep in mind. So we'll be also watching the 50 days moving average. Comes Monday, Tuesday. Can we close above, or are we just going to stay below? Because if it comes Monday, Tuesday, and the SPY fails to close above the 50 days moving average, then you squeeze the majority of the good seasonality. You couldn't close above it. So when we come after the holiday, you're probably going to go down. Keep that in mind. So the trades that I got for you, bullish trade for NVIDIA. We buy the 135, 140, 145 call butterfly spread. Expiration date this upcoming Friday, December 27th. And then we complemented with a bearish trade, but this one's going to be the 600, 595 SPY credit call spread. The same expiration date, December 27th. And I said, all in all, I get exposure to both outcomes while getting paid to do so. And my risk in the credit spread is manageable. We cut loss when we pass above 595 at any time. And here's the trade for you. So NVIDIA, 135, you buy the 135, you sell the 140 twice, then you buy the 145 calls as a hedge, and it costs about $1 a piece. So it's not really that expensive if you use the butterfly structure. And it gives you exposure to the upside. If, say, NVIDIA goes above 140 but stays below 145, the trade will be profitable. But again, we complemented with this trade, which is the bear call spread. In this case, we sold the 595 calls, we bought the 600, and we netted a credit of about 180. That comes down to $1.80 a piece per option. So all in all, the trade netted us about 80 cents in credit. So you know if you go down below 80 cents or at 80 cents worth of a loss in the credit spread, that's going to be your cut loss in it. And then you're probably going to see NVIDIA heading higher, so you want to keep that trade going. But with that, folks, I hope you enjoyed this video and gave you a little bit of an update on what to expect in this upcoming week. And of course, we'll be back tomorrow in Discord. We'll be back again with the daily show tomorrow. So stick around, folks. Thank you for listening. Thank you for watching. Appreciate and love all of you. I'll be talking to you again tomorrow. Good night.